Hi, in this video, we will be discussing focused funds. A focused fund is a type of an open-ended mutual fund that invests in a few handful stocks. They have little focus on diversification and only invest in a small variety of stocks or bonds. As per SEBI guidelines, a minimum of 65% of their portfolio should comprise stocks. They are taxed just like any other equity mutual fund. Unlike other mutual funds that invest in a wide variety of stocks from different sectors and industries, focused funds invests in only a few instruments or industry-specific companies. Regular mutual funds can have as much as 60 stocks in their portfolio, whereas focused funds usually have less than 25 to 30 companies in their portfolio. Simply put, the idea behind focused funds is to avoid diversification. Many investors believe that diversifying leads to lower returns on investments, as not all companies and sectors are likely to outperform. A focused fund is built with heavily researched and carefully evaluated instruments, which can provide good capital growth in the future. Their strategy is to search for quality companies which could have the potential of high growth in the future. Focused funds are also known as concentrated funds. Now let us discuss some advantages of such funds. First, of course, is the power of research. Extensive research leads to picking stocks that could be above average when compared to other mutual funds. This in turn means higher returns when compared to the benchmark index and other mutual funds. Another advantage a focused fund has is that it removes a major disadvantage of diversification. A mutual fund in general invests in multiple sectors. Underperformance by any one sector can limit the overall profit of the mutual fund to a great extent. Such problems do not exist in a focused fund. But higher returns also come with the caveat of higher risks. So let's understand the disadvantages of focused funds. Even though extensive research goes into stock selection, it cannot be taken for granted that these stocks will have high returns. Changes in the fundamentals of the companies or sudden economic shocks can lead to losses and underperformance. Though we spoke about how diversification could be a disadvantage, it can also be an important tool to safeguard your portfolio. Since focused funds do not diversify, if a certain company underperforms, it can lead to massive losses to the investor's portfolio, as the exposure to other companies will be limited. Focused mutual funds are more suitable for investors who are experienced enough in the market to understand and interpret research. Lastly, focused funds are also more suitable for investors with a long-term investment horizon, as these funds are known to give efficient returns after an investment of 5 to 7 years in general. Thank you for watching this video.